Okay, we got a lot on the go this week. A Bank of Canada interest rate decision. We'll see what the inflation picture looks like in the United States. We're going to start getting into earnings season stateside with some of the banks starting to report their quarterly results. And investors, sure, they're taking a peek at all of that, but they do seem to be doing a bit of fence sitting right now. The TSX a little bit weaker, the U.S. markets a little bit higher. Let's bring in Bryden Teich to get some perspective on that. He's a partner and portfolio manager at Avenue Investment Management. Nice to see you.
Good to be with you, John.
I mean, I know it's the summer, but I feel like in our recent visits, it's kind of the same old song that investors just aren't sure what they want to do just yet.
Yeah, I think, and the theme continues to be, a potential, recession in the fall into next year, which is people have been talking about for a year, and it just hasn't seemed to been here yet. At the same time, the market in the U.S. appears to be incredibly resilient, and as you say, entering July, August, sort of the quieter parts of the year. Our bias would expect a market that kind of just drifts higher on even just lower volumes into the summer. I think the CPI in the U.S. this week, you've got the central bank in Canada this week. All of those things are news items that could lead the market, one way or another. But I think that we're entering what would be a quieter period of the year.
I mean, it's a thankless job to try to explain market moves.
Well, I don't want to be in your
sometimes
shoes.
a bit of a roll of the dice, and it's a thankless job to try to predict where the markets are going.
It's easier to say you have no idea. Yeah.
But, I get a lot of feedback from our audience that say, John, some people say stay in tech stocks. Others are saying get into cash. Others saying the fixed income world looks good right now. I guess all could be true, but does it feel like because we're not quite sure the path ahead that you can, throw different ideas out there and have justification in all of them?
I think to that exact point, I think there's a fair argument that you could make for all of those different asset classes here. I think it comes back to, what level of extremeness do you have in your view? I think we would say, our expectation is a recession's coming. We don't have to try to predict exactly when. We're already kind of prepared for that environment. But at the same time, there's lots of companies that we think are in great shape today. Yeah. And so we don't want to necessarily get too negative on the macro because that's really not what we try to do. And I think that, there's also this aspect where everyone wants to grab the headline with, the more shocking prediction of S&P is going way higher, or S&P is going way down, or there's a massive recession or whatnot. We kind of cut through all that noise, and we don't really change what we do based on the economic outlook.
So you said you're prepared. How did you prepare?
So the one thing, the benefit of having really short-term interest rates is we're now about 15% in T-bills, where before it would have been harder to have any cash at 0% rates, but at 5% short-term rates, you're getting paid an income to be defensive. And so what we focus on is companies where we have confidence in their earnings through a recession and onto the other side. At the same time, as there's less and less things that meet that criteria, we're happy to be raising cash and putting that into T-bills, getting paid to be patient and wait, knowing that we're pretty uncertain about what the economy is going to look like in 6 to 12 months from now.
That's a helpful point, and we had a guest earlier who advised people not to chase the market. I guess if you're getting paid to wait, you don't have to. But again, like chasing the market, like which market? Like AI stocks? Okay, maybe that's one story. But do you find yourself on certain days looking at names that maybe are less loved but could potentially move higher, where you're like, well, I want to take some of that money out of T-bills and put it into the game?
Yeah, it's harder because you're in a market where, as it gets thinner and thinner, you want to stick with what's working. And I would say that we're definitely not in a position to go in and look at all the losing stocks right now and pile into them, because I think that you want to own things that are resilient, and you want to own things that you have confidence in as an investor through a recession. And if you aren't confident with what you own based on that criteria, I would say you should be skeptical of what you own. We spent the last year going through that process, kind of really refining and tightening it down. But I think for the average investor, you don't want to chase the market, you don't want to get too afraid, but you have to have a plan and stick to that. I think that's something that people should always keep in mind.
Okay, I want to talk about individual ideas, but before I get that, when you talk about a thinner market, are you just talking about like the summer is quiet?
So thinner in that there's less stocks going up. So if you look at breadth, as we talked about, that's not a healthy development. So the market could go to new highs in the U.S., but if it's only because a few stocks are going up, that I wouldn't view that as a positive development. Some people are so focused on what level is the S&P at on any given day. We've seen the positive sentiment return to the market. So percentage of bullish investors has now gone to levels that we haven't seen in a year. So all of that is like you're getting to a euphoric moment. And if we were to push higher from here, I would say, you're really approaching a risk-off moment.
I was just smiling because given the environment we're in, I've felt like, we're playing Moneyball over here. Like I've heard all the analytics on the bearish and bullish side. So the thin market, like there are people that have great stats on when you actually have a thin leadership market. That actually is great for the S&P 500.
Yeah.
So I don't want to, for people who have an ETF tied to the S&P, could be a helpful winning story.
Well, but at the same time, all you should care about is the S&P going up if you own the S&P.
Right.
So if it's thin or fat, it doesn't matter.
Right.
But I would say from our indication is that, that's not really the healthiest thing right now.
Okay, so let's take a stock called AutoZone, which you shared with our producer. And again, if people look at the number of vehicles that are on the road right now, and the average, I know we talk about EVs, but the number of combustible engine vehicles on the road, their average age, and what typically happens to stocks like AutoZone in a recession, I would guess that all plays into why you're thinking about a name like this.
Exactly. So the average age of a car in the U.S. is now about 12 years, which is the highest it's been, in historical record. I think the vehicle miles driven per year is about 3 trillion, which is pretty stable. So as cars get older and the price of new cars goes up, more cars are off warranty, more cars need parts. It's really simple logic. And so you could have the EV going on in one segment of the market, attracting capital, where the traditional auto retail, it's really a boring, dormant business. But if you're a dominant player like AutoZone, it's a great way to have super stable profits. And then because their business needs so little capital, after investing in the business, they just buy back their stock, which then creates a demand for the stock. So it's kind of a reflexive loop with a company like that, which we, frankly, if the stock were to come off and go down, it would be great because we could buy more. As long-term investors, it's a business that we're happy to own in any kind of economic environment.
Before we go, I know we're out of time. Is there a Canadian name that it doesn't have to be in the same industry, but kind of has the same kind of dynamics, bodes well in a recessionary environment?
Yeah.
Sorry to put you on the spot.
So one that we would highlight that once again, similar characteristics to AutoZone, Couche-Tard. Awesome business. They're now almost more than half in the U.S., but super stable, super consistent, a business that we're happy to own in any kind of economic environment and has very similar characteristics to AutoZone.
Okay.